This segment focuses on the Keynesian model, specifically dealing with the consumption function and the investment function of our gross domestic product as developed through John Maynard Keynes. Before we get going any further, I just want to point out a few distinctions. There's really a couple of different theories when it comes to economic theory. What we've really been exposed to so far is a classical view, and that's the notion that if left alone, the economy will eventually correct itself through that market system. Remember, a market occurs whenever supply and demand intersect or whenever they're involved. If there's a greater supply of something, ceteris paribus, the price will go down. If the demand increases for something, the price will go up. If left alone, prices will ultimately settle at equilibrium. Sometimes, though, there is some involvement. In fact, sometimes these adjustments to the market, they take a while to work. And remember, too, that with every commodity, whether it is corn, desks, oil, wages as well, labor, has a price on it. So we could see a lot of fluctuating in prices. And again, the classical view states that as long as there's no outside interference, the economy will correct itself spontaneously, but you have to remember that spontaneously does not necessarily mean quickly or immediately. It could take some time. Jean Baptiste Say developed a law along the classical lines that basically said the economy is greatly affected by the supply. Supply creates its own demand. If there is a large supply of labor and the demand is weak, the price of labor will go down. People will be willing to work at a lower wage. When that happens, employers will demand more workers because they cost less. So that will mean that employment will go up, thereby increasing their paychecks and increasing spending. So it's very much supply-driven or supply side. Now, in the 1930s, a gentleman by the name of John Maynard Keynes really challenged that. And you have to remember at this time, we were in the midst of a Great Depression. And the notion was sometimes the government needs to get involved because the whole market system isn't working quickly enough. John Maynard Keynes really believed, and this is supported in many of the theories and the models that you're going to be taking a look at, that the government should play an active role in the economy. His focus was more on demand. Demand creates its own supply. So we're going to be emphasizing expenditures greatly in this unit. Let's go ahead and look at John Maynard Keynes' theory a little bit more closely before we get into some of the calculations. Okay, so Keynes. John Maynard Keynes, again, what do you need to know? 20th century, Great Depression was going on. The market was not curing the situation that we saw, like 30% unemployment. So the emphasis was we need to step in. He felt we need to step in, and maybe the government should increase spending by demanding bridges, by demanding roads and a lot of the projects. An example is the Blaine Theater in Boscobel, Wisconsin. That was a project created really to get people back to work. By the government demanding infrastructure, it created these projects which demanded labor and put people to work. They therefore had paychecks and they could increase spending and things like that. But the big emphasis with Keynes is on the gross domestic product. In fact, we attribute him to that equation that you learned so well in Chapter 5 of the GDP. Consumption plus investment plus government spending plus net exports is equal to the gross domestic product. Aggregate means total. And this is the gross domestic product as calculated through the expenditure approach. So C plus I plus G plus X. Consumption plus investment plus government spending plus net exports equals aggregate expenditures is equal to aggregate demand, aggregate spending, and that GDP. Okay? Generally speaking, though, although these are synonymous, aggregate expenditures, aggregate demand, and aggregate spending, we're mostly just going to be referring to that as aggregate expenditures. Now let's go ahead and look at the consumption function a bit more closely. Again, this chapter, Chapter 8, focuses on the consumption function and investment function. So spending by consumers and then spending by businesses into increases in productive capacity. Like if a company adds on, if they buy more tools, if they bring in another wing and more capital equipment. That's the business investment that we're talking about. We're going to focus on the consumption function though right now. First of all, let's just introduce you to a few more abbreviations or variables that we're going to be focusing on. YD is an abbreviation for disposable income. Disposable income you calculated in Chapter 5. You calculated the gross domestic product, C plus I plus G plus X, and then you fine-tuned that a little bit, and you came up with the national income, and then you made some adjustments to national income, and you calculated the personal income, and then when you calculated personal income, you subtracted taxes owed by folks based on their income, and what we were left with was disposable income. This is the dollar amount that is available to either spend or save. So YD is disposable income. S stands for savings, and C, as you know, stands for consumption. Our entire disposable income, YD, is either spent or saved. If I have $100 worth of income and I spend $95 of it, I'm saving the remaining $5. I have to do something with it, right? The $5 in savings doesn't necessarily mean that I put it into a passbook savings account or bought stock in it. I could have put it in a jar that keeps coin. The fact is I am saving it for another purpose or for a different day. Okay, so therefore disposable income, YD, is equal to consumption plus savings. The $95 that I consumed plus the $5 that I saved equals the $100 of disposable income. And again, you can modify the equation a little bit. YD equals C plus S. As long as you have two of them, you can solve for the third. If you want to find out what savings is, take the disposable income and subtract consumption, and there you're left with the savings. In the example I just gave you, disposable income of 100 minus consumption of 95 left me with $5 of savings. Or we could solve for consumption. Disposable income of $100 minus the $5 in savings gave me a consumption of $95. What I've done is I've just copied a few of the slides out of the textbook, just duplicated them here, and we're going to go through a few of them. These numbers are always going to be given to you. This again is our consumption function. It shows the relationship between or among disposable income, consumption, and savings. We know that disposable income is equal to consumption plus savings. C plus S is always equal to disposable income. What we do not consume, we save. Now let's take a look at this situation when disposable income is 0. Notice that some consumption still occurs. We have $1 in consumption. We know that C plus S has to equal disposable income. So savings is minus 1. Now what this means is pretty clear. When we're not making any money, we still need to make some payments. Usually it's those necessities, the food, water, and shelter type things. And we'll assume that that consumption is $1. We're not bringing in any disposable income. So how are we going to satisfy that consumption need? We're either going to withdraw from savings, therefore the minus 1, or we're going to borrow that money. So the negative comes from either borrowing or withdrawing from savings. Let's go ahead, we'll just skip to $2. Okay, when disposable income is $2, consumption is $2.50. Again, our total consumption is $2.50. $2 of that consumption is going to come from our disposable income. The remaining 50 cents is going to come from what we would refer to as dis savings. We're either going to withdraw it from savings or we're going to borrow it. Let's go down a couple different levels. We'll go down to $4. Now note at $4, disposable income is $4. Consumption is $4. What is our savings? It's 0. Again, consumption plus savings must equal disposable income. So here's a point where every dollar that we receive in disposable income is being consumed. None is being saved. We'll learn that that is what we call break-even income. Let's go down, we'll say, to $7. At $7, our disposable income is $7. Of that $7, $6.25 will be consumed. The difference then between the $7 and the $6.25 in consumption is going to be the dollar amount saved, or 75 cents. Again, $6.25 consumption plus 75 cents savings equals the disposable income of $7. So that's a table. Let's just give you some notes that highlight some of the things that we learned by going through that table. At low levels of disposable income, YD, savings is negative. And you saw that when disposable income was less than $4. We saw negative savings rates. What does that mean? That means consumers are either withdrawing money from their savings accounts to meet needs, or they are borrowing. So at low levels of disposable income, we see this thing going on, dis savings. There's a certain amount of spending that always occurs no matter the disposable income. That is what we refer to as autonomous spending. The consumption that occurs when disposable income is zero. It covers things such as housing and other basic needs. Now, if I pull this consumption function up again, we see that when disposable income is zero, consumption isn't zero. Consumption is $1. This is the autonomous consumption. This is the consumption that occurs even when disposable income is non-existent. How are we going to satisfy these consumption needs? We're either going to withdraw it from savings or borrow it. Again, this is what we refer to as autonomous spending or autonomous consumption. When all disposable income is being consumed, we have that break-even or no saving income. Break-even is the most common term to describe that situation when YD is equal to C and there is no savings. Again, that is our break-even. And then at levels of disposable income that are greater than, that exceed break-even, there's actually some positive savings occurring. And again, that occurs whenever we are beyond that break-even income. Break-even was $4. Disposable income was $4. Consumption was $4. Savings was $0. Any dollar or any amount that exceeds $4, could be $4.01, $4.02, $4.25, or whatever, we are going to see some positive savings occurring. We're going to look at another tool to help us use consumption and the likelihood of spending versus the likelihood of savings in order to predict what might happen to that gross domestic product or aggregate expenditures. Here we're going to introduce you to the marginal propensities to consume and the marginal propensity to save. Now, let's just take a look at those two words. Marginal means additional. Propensity is the likelihood or the inclination. So we are looking at the marginal propensity to consume. That is the likelihood of additional dollars to be consumed. The marginal propensity to save is the likelihood that additional dollars of income will be saved. So the MPC is the marginal propensity to consume. It again is the inclination or the likelihood to consume additional dollars of income. It is found by taking the change in consumption, dividing it by the change in real disposable income. The MPS is the marginal propensity to save. It again is the inclination or the likelihood to save additional dollars of income, and we find that by taking the change in savings and dividing it by the change in disposable income. Let's look at that MPC just a little bit more closely. The MPC, again, marginal propensity to consume. Very important. It is not total consumption divided by total disposable income. It is the change in consumption divided by the change in real disposable income. To abbreviate that a little bit, we have our MPC is equal to the change in consumption divided by the change in YD, or the change in disposable income. Note that this triangle here is delta, and all that means is change in. So the change in consumption divided by the change in disposable income will give us our marginal propensity to consume. And that, again, is what percentage of each additional dollar of disposable income is society going to consume versus save. In this case, if disposable income increases by $2,000 and as a result consumption increases by $1,500, the MPC is 0.75. The change in consumption increased by $1,500 divided by the change in disposable income. Disposable income increased by $2,000. So $1,500 divided by $2,000 gives us an MPC of 0.75. And again, what does that mean? Ceteris paribus, if everything else stays the same, for every $1 increase in disposable income, consumers will spend 75 cents. You know, for every $1,000 increase in income, consumers will spend $750. They will then save the remaining portion. What they do not spend, they save. What they do not consume, they save. So the savings in this case would be, you know, 25% of those additional dollars of income. Let's look at the MPS. The MPS, again, change in savings divided by the change in real disposable income. The MPS, the change, delta again meaning change, the change in savings divided by the change in disposable income. If disposable income increases by $2,000 and as a result consumption increases by $1,500, then savings must increase by the difference because savings and consumption have to equal disposable income. So the savings increases by $500. Change in savings divided by the change in disposable income gives us an MPS of 0.25. We could also just subtract the MPC, the 0.75 from 1.0 in order to find the MPS because the MPS and the MPC together equal 100% of our disposable income or that additional income that's received. In other words, for each dollar change in income, a portion of that dollar is consumed and a portion of that dollar is saved. If additional income is $1, then the MPC plus the MPS must be 1. In the cases that we've been taking a look at, the MPC was 0.75, the MPS was 0.25. 0.75 plus 0.25 gives us 1. 100% of the additional dollars are going to be either consumed or saved. Now let's see how this relates to the consumption function because that's the focus right now, or at least in this chapter. Recall that the gross domestic product is found by taking the consumption plus investment by businesses plus government spending plus net exports. Gross domestic product is, again, total spending or aggregate expenditures. We can predict, this is very helpful, we can predict what consumption is going to be if we know a few things. Basically, what the MPC is, you know, what's the likelihood that we are going to consume, and also what's the level of disposable income. So let's take a look at the formula for predicting that consumption function of the gross domestic product. Again, we can predict C, consumption, by knowing what the autonomous spending is. That was that spending, or excuse me, the consumption that occurs even when disposable income is 0. And if we know what the MPC is, the marginal propensity to consume as opposed to save, and the disposable income. Here's our equation. Consumption is equal to A plus B times YD. All these things are just little puzzle pieces. We know what C stands for. That's the consumption function of the GDP. We will be able to predict what at least C is going to be in our gross domestic product by taking autonomous consumption and adding that to a factor B times YD. Now we know what YD stands for. We said YD is disposable income. B is going to be that marginal propensity to consume. This is, again, the likelihood to consume additional dollars of disposable income. Let's take a look at an example. Let's assume the following. Autonomous spending, autonomous consumption is $1 trillion, and the marginal propensity to consume is 0.75. Again, what does that mean? That means for each additional dollar of income, 75% of that dollar is going to be consumed, then 25% of it is going to be saved, correct? Real disposable income is $4 trillion. Substituting what we know into the equation that we just took a look at, C equals A plus B times YD, we get this. Consumption is equal to A, that's the autonomous spending, plus the MPC times the disposable income. C, just simplifying, we get $1 trillion in autonomous spending plus $3 trillion. Now, where did we get the $3 trillion? We took the MPC of 0.75 and multiplied it by $4 trillion. So we get $3 trillion in additional dollars of spending in addition to the autonomous spending. So the consumption function will be $4 trillion. Now let's say that there is a change. We're going to assume everything remains the same except the marginal propensity to consume. Maybe we start getting a little pessimistic about the economic future. Maybe we hear that unemployment is increasing, or that gas prices are going to be going up, or there's more threats of terrorism, or interest rates go up, that we just don't want to borrow as much, and when we don't borrow, we don't spend. Whatever the case may be, our marginal propensity to consume has decreased. We were consuming or spending about 75% of each additional dollar of income. Now it's only 0.6 or 60%. So again, the MPC has changed. It's now 0.6. Autonomous spending has stayed the same. That's $1 trillion. MPC of 0.6. Real disposable income has stayed the same at $4 trillion. Our equation now looks like this. Again, C equals A plus B times YD. Remember, B is our MPC. So $1 trillion plus 0.6 times 4 trillion leaves us with, we always have to do the multiplication first, right? 0.6 times 4 trillion gives us 2.4 trillion. We add that to the $1 trillion of autonomous spending, and we get a consumption of 3.4 trillion. Now previously, when the MPC was 0.75, consumption was predicted to be $4 trillion. However, this has changed. People are more pessimistic. They're concerned about the future. They're hanging on to more dollars. They're saving now 40%, and they're consuming 60%. It's expected that the consumption function will decrease then. Now, if that happens, is that going to impact the economy? Yeah. Will it impact unemployment, the gross domestic product? Will it further create more pessimism or optimism? Well, in this case, probably more pessimism. And the reason behind that is the consumption function is the largest component of the gross domestic product. We have consumption plus investment plus government spending plus X. And if this decreases and everything else remains the same, we're going to see our total gross domestic product go down. Remember that you learned when the GDP declines, when we see a decrease in overall economic activity, we see a decrease in goods and services that are produced. Therefore, we don't need as many people working. That means people get laid off. We see unemployment go up. We see more businesses fail because there aren't enough customers. We see fewer tax dollars being paid into the government, federal, state, and local, because people aren't working as much, and also because businesses are less profitable. We also see things such as crime rate go up. So this MPC is pretty significant. How we feel, what percentage of each additional dollar of income we're going to consume has a significant impact on the entire economy. So keep in mind that this has a significant impact on the entire economy. I'm just going to put some notes up here, and again, it just describes the impact. You have this available on the PowerPoint and the lecture notes, but this is just a little video clip, so I'm going to just emphasize a few things. Remember that consumption is the largest component of the gross domestic product. A decrease in consumption may be offset if business investment, governments increase spending, or foreigners purchase more American exports. In other words, if I goes up, if G goes up, or if X goes up, that may counter the impact of a decrease in consumption. However, they might not. Usually they're not going to. I mean, if left alone, we aren't going to see an increase in government spending. We might see the government get involved to correct something, but it's going to have to make a deliberate attempt to do that. Again, assuming I, G, and X do not increase, we're likely to see a decline in economic activity and all those negative things that go along with it. Here's where Keynes really enters the equation. Keynes argued that the government can affect economic activity by adjusting tax rates and transfer payments. Tax rates and transfer payments impact disposable income. So if we see tax rates go down, we will see disposable income go up. Even if the marginal propensity to consume remains the same, if YD increases, we could see our gross domestic product be not as negatively affected as it would be had we not decreased the tax rates. Transfer payments are those things that increase disposable income. These are things like Social Security payments or unemployment or VA benefits and disability. If the government increases those transfer payments, or as we've been seeing, if the government lengthens the period of time that a person can collect unemployment, we will see disposable income increase. And remember your equation. That equation is right here. Autonomous consumption plus B times YD. Even if this stays the same, if our marginal propensity to consume stays the same, but if this increases, we could certainly see consumption increase. Now, what is it going to do? I mean, how would the government take a stand in certain conditions? Well, let's go ahead and take a look at what might happen if we have a slowdown, if we're experiencing a contraction. And as you should recall, I'm just going to draw our business cycle here. We had the GDP on our y-axis, and this was in dollars, and we had time on our x-axis. So we'll just say that this is year 1, this is year 2, this is year 3, this is year 4, etc. We see that there's an increase in the gross domestic product over time, and then we see that it goes down, okay, and then we'll see another increase. I'm just going to put a few more years here. When there's a positive, when the gross domestic product is increasing, we call that an expansion, oftentimes referred to as a recovery. We then have a peak right here, and then when we see a decline in time in the GDP. So again, our gross domestic product is getting smaller. At year 4, the gross domestic product was right here. This is 0, so the more above we are of 0, the greater the number. And year 5, here's the gross domestic product. We see that we've seen a decline. This again is what we refer to as a contraction. It is a decline in economic activity. When this happens, that's when we see, the GDP is going down, we see unemployment going up, we see crime rates going up, we see businesses closing down, etc. So what could the government do? If the government follows Keynesian economics, the government says we need to correct this. Classical economists are going to say back off and let the market correct itself. People who follow more government involvement, and it doesn't have to be extreme. What we've seen, in the first part of this millennium, actually, we have seen a lot of government involvement. So much so that additional government involvement is not producing any impact. Keynes really argued later on in life that government should be involved, definitely, but not so much so that it's controlling the economy. Because these things, like what we're going to talk about, these tools, taxation and transfer payments, they should be used to cure a problem, but they should not be used so regularly that when we need a fix, we don't have that fix to use because we've been relying on it all along. So during a contractionary cycle, again, that's the downturn in the economy, the government maybe says we want to increase the consumption function to encourage growth in the gross domestic product. It can do so by doing these two things. It can decrease tax rates, or it can increase transfer payments. Either of these actions will increase the real disposable income and thereby stimulate consumer spending. And this is true even if the MPC stays the same. Now, some examples that we've seen. During the Bush administration, there were it was the economic stimulus package of, I believe, 2003. In fact, I would say nearly all households, most households saw their disposable income go up because tax rates were pushed down. Now, why did that happen? Now, this was an attempt to increase the GDP to get consumer spending going. So what happened was this administration said we will decrease taxes so disposable income increases. Disposable income increased. Even if the MPC stayed the same, we're going to see the consumption function go up as a result. Another thing that could have happened, and certainly did, transfer payments were increased. So this again affected the disposable income. People were given Social Security cost of living adjustments, and that's usually something that we see happen on an annual basis. but you know, unemployment was extended for longer periods of time. If we increase those transfer payments, that's disposable income that has gone up, and that has a positive impact, generally speaking, on the consumption function. It is, though, dependent on the marginal propensity to consume. Now, during the first term of President Obama, those Bush tax cuts were extended. Again, the whole idea was this: we will get that total gross domestic product increase, increased growth. That's going to lead to more consumer spending. That's going to lead to businesses investing more, and that means they're going to hire more people, order more raw materials, order more equipment, and the like. So during a contractionary cycle, what's going to happen? The government, if they choose to get involved, is going to decrease tax rates or increase transfer payments. Now, what if we see inflation? During inflation, we see prices that are going up. We're not achieving that goal of price stability because prices are going up. There's too much money chasing too few goods. I'm just going to draw you a graph. I'm sure you've probably missed graphs maybe by now. Let me illustrate what I mean. We're going to look at any good. We'll look at good A, and we have price on the y-axis, and we have quantity on the x, and we have our supply curve, and we have our demand curve, and this is the equilibrium price. Well, let's say a lot of people are working. That's cool. A lot of people are working, but a lot of them are spending and spending and spending and spending. Maybe the marginal propensity to consume has gone from 0.6 to 0.75 to 0.92. Whatever it is, because their incomes have gone up, the demand for goods and services has increased as well. Here's my new equilibrium. What do we know about that? The prices have gone up. So overall, what we have, assuming that supply stayed the same, we have increasing prices. Now, an overall average increase in prices is known as inflation. It is not good for the economy. In fact, most economists call inflation public enemy number one because there's no incentive to save. Why would I save $10 today to buy something in the future that's going to cost me 2 times as much next year because prices keep going up? So the government may say, we need to do some scaling back here. We need to get people to spend less money. If they spend less money, prices will stabilize. So what their attempt is to, affecting demand here, that's the Keynesian way, is to decrease the demand for goods and services, and that will bring prices back down. Now, how can it do that? Can it just suck money out of our checking accounts? No. It's got a couple tools, and those tools, as you know, are transfer payments and tax rates. So during inflation, the government's goal is to decrease the consumption function, to get inflation under control. It can do so by increasing tax rates or by decreasing transfer payments. Even if the MPC stays the same, this is what's going to happen. When we look at our equation again, our equation for the consumption function, consumption is equal to autonomous consumption plus B, our MPC, times disposable income. Well, let's assume that B stays the same, and let's assume that A stays the same. If disposable income decreases, we are going to see the entire consumption function decline. How can that happen? Increasing taxes. If taxes go up, our disposable income goes down. You have your gross pay that you might get on your paycheck, and then you see all those deductions, and then you see your net pay. If your taxes go up, what happens to your net pay? It goes down. That's disposable income shrinking. You have less money to spend. Another tool is the transfer payments. The government could choose to maybe decrease unemployment compensation or decrease the term that a person can receive unemployment compensation. They could decrease Social Security payments or disability and the like. So these are just some tools regarding the consumption function that the government could take if it followed Keynesian philosophy in order to correct the economy. I want to just do a couple of questions just to practice some of the things that we've learned. We'll just do these right in class. If income increases from $110,000 to $120,000 and consumption increases from 108,000 to 114,000, the marginal propensity to consume is what? Well, remember the MPC is equal to the change in consumption divided by the change in disposable income. Emphasis on change. The change in consumption. Consumption went from 108,000 to 114,000. That is a $6,000 increase in consumption. And that occurred as a result of disposable income increasing from 110,000 to 120,000. So the change in disposable income is 10,000. That gives us an MPC of 0.6. Is that one of my options? Yes, thankfully it is. Okay, let's do another one. This says, use the table below to answer the questions. What is the marginal propensity to consume? We look at our headings. Here is income. This is our disposable income. Here is the consumption. Consumption went from 58,000 to 62,000. So the change in consumption is $4,000. The change in disposable income, we went from 6,000 to 66,000. That is a $6,000 change in disposable income. So we take the 4, we divide it by the 6, and we get 0.67. So that is the MPC. We'll do another one here. Marginal propensity to consume. You have this down by now, I would imagine. Change in consumption, 4,000, divided by the change in disposable income. We went from 45,000 to 5,000, so the change in disposable income was 5,000. That gives us an MPC of 0.8. If the MPC is 0.8, do we know what the MPS is? We certainly do. The MPS is going to be 0.2. I know that because the MPS plus the MPC has to equal 1.0. If I know what they're both going to equal, that's 1.0. So if I know the MPS or I know the MPC, I can very easily solve for the unknown. Let's just do a couple more questions. If consumption spending is larger than disposable income, what is happening? So we have our disposable income, that is a certain amount, and we have consumption that is greater than that disposable income. When that occurs, we're going to have to do something as consumers in order to pay for this spending. Now, how are we going to do that? Let's just take a look at this consumption function. The question reads again, if consumption spending is larger than disposable income. So from $3, a disposable income of $3 and below, we see that the consumption is greater than the disposable income. For each one of these, consumption is greater than the disposable income. We also notice that we had dis-savings occurring at that time. So savings is certainly not positive. Dis-savings occurs. We are withdrawing money as consumers out of savings accounts or we're borrowing. We'll do a couple more questions. Consumption spending that is independent of the level of disposable income is known as what? In other words, there's a certain amount of consumer spending that occurs no matter the level of disposable income. We call that, again, autonomous consumption. Let's take a look at this one. And again, I want to encourage you to read very carefully. Some of these are going to ask for an MPC, some will ask for an MPS. Some are going to ask for things such as autonomous consumption. Given the consumption function, C is equal to 100 billion plus 0.75 times 300 billion. Autonomous consumption is equal to. Okay, now generally we have this, oh, I know how to do this. I'll take 0.75 times 300, add 100. We are not asking what is C, what is the total consumption. You are being asked what is autonomous consumption. And autonomous consumption is right here. That is that $100 billion. So that's the dollar amount of consumption that occurs even when disposable income is zero. The marginal propensity to consume is computed as the change in what? Well, the change in consumption divided by the change in disposable personal income. That's how we find the MPC. Is that one of our options? It certainly is. B, the consumption divided by the change in disposable personal income. So those are just some examples you have. I want to strongly encourage you, again, to read very carefully, because sometimes a question is going to ask you for the MPC. Sometimes you might be given the MPC and they're asking for the MPS, so read very, very carefully. I hope this helps you through Chapter 8 regarding Keynesian economics, or excuse me, it's Chapter 10, Unit 8.